You're about to hear my conversation with David Ross, Managing Director and Head of Private Credit with Northleaf Capital Partners. Today, we'll talk about what explains the explosive growth we've seen in private credit over the last 15 years, how a Fed easing cycle could impact the investment experience for those in private credit, and a potential use case for private credit involving the portfolio of a high net worth Canadian. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction and Mackenzie Private Wealth. Today, I'm joined by David Ross, Managing Director and Head of Private Credit with Northleaf Capital Partners. David, thank you for joining the podcast today.
Great. Thanks for having me.
Of course. Now, David, I'm going to go right into my questions. My first one is private credit. This is a burgeoning asset class. It's always featured in the financial news, but it's also a broad umbrella term, and some of our listeners might still be getting up to speed on the space. How do you define the broad private credit space?
Yeah, you're right. It is a good place to start. I mean, private credit is a broad space. You're right. And it includes a number of different asset classes. So you can start in things like venture or infrastructure lending, all the way to distressed or special situations, even asset based specialty finance. I think really the key thing is focusing on it. It's a credit investment, not readily tradable. It's typically privately negotiated between one lender and a borrower, or maybe a small group of lenders. And it's a big space. So it's, over $1.5 trillion. And when we think about what most people refer to when they say private credit, is they're generally talking about corporate direct lending. That's the largest and most popular segment of the private credit space. It's about half the AUM. And it's also the easiest access. So when you think about investors, it's become more popular and people understand it because you're lending to corporate businesses that they can touch and feel and understand. So it actually very similar to traditional fixed income investing. So when they think about their portfolio, it's a nice addition. It's a performing asset class, got good cash yield. So most investors like it for that stability and consistency.
Excellent. And in fact, that is a fabulous place to start our conversation and frame the rest of our discussion. I'm curious, David, you referenced a market that's north of $1.5 trillion. What explains the explosive growth we've seen in private credit over, let's say, the last fifteen or so years?
Yeah, I mean, it's definitely something that's been a focus for both investors and the market as a whole. And it's not easy to summarize the last 12 years of evolution. I started in the market in 2003. I guess from my perspective, there's probably been three big themes that are probably the easiest way to think about the evolution of the market. The first is, and this is true for us personally as well. I mean, banks are no longer the sole or even the primary source for financial products and services. We see that with mortgages and FX when we're doing trading, even bank brokers. Back in the day, everybody would use a traditional bank broker, and just all of those products and services have evolved. And in the private credit space, post the global financial crisis, like many other parts of the financial markets, private credit quickly transitioned away from being a banking product where they would hold it on their balance sheet and provide it as a service to their corporate clients, to something that institutional investors like Northleaf would provide. So you've had this secular trend away from banks as a key provider of the loans. And that's been one of the key kind of increases in the market, if you will, even though it hasn't generally been a scaling, it's been a transition, and that's attracted a lot of attention. The second piece, and probably the piece that's driven the mid teens annual growth over the course of the past 10 or 15 years, is just the growth of private equity in general. So, over the past 20 years, private equity firms have grown substantially, both in terms of number and in terms of scale. And private credit is really the key financing source what that they use for both acquisition and growth of their portfolio companies. So, private credit has essentially become the key source of capital for those borrowers. And most of them would now work with a private lender like Northleaf. Instead of going to a bank, they'd go to a couple different private lenders to try to get the right capital to do their acquisition. And as I said, that's been probably the key driver that's increased the growth to now close to $2 trillion across private credit. And then the last thing, which I think is really important and people often neglect to think about, is it didn't used to be thought about as an investment. I mean, when I started in 2003, loans were just a thing that banks did. And so over the last 20 years, I think pension plans, insurance companies, sovereign funds, even now more increasingly, individual investors and family offices have really come to appreciate that a floating rate return from a private credit loan has really provided banks with really good stable income over the last 20 or 30 years. And now it's being used to replace or complement public fixed income as a good place to get attractive cash yields. I mean, the 10-year annualized return in private credit is 8.5%. I mean, who doesn't like that cash yield, floating rate, low volatility type complement to public fixed income?
David, thank you. That is very insightful. Loved how you referenced private credit as an investment. Very interesting how you noted private credit, key source of capital given the growth of private equity, but also post the financial crisis, private capital has moved from banking to the institutional space. Now, big space, a lot of institutional players. Northleaf, well established Canadian firm. I'm just curious. Did my homework in advance of our conversation, David. Northleaf focuses on the mid market space, specific to private credit. What does mid market actually mean?
Yeah, so mid market means for almost anybody today, a company with EBITDA of $10 million to $100 million. So you're talking about companies with an enterprise value of about $150 million to about $2 billion. And what's important to note about this space is it's still very relationship driven. So you can imagine these companies at that size are pretty scale, right? They've got diversified customers, diversified suppliers, but they're still really too small for public markets in any way, shape, or form. And the other thing that's really important is private equity firms that are focused on the mid market space generally have the scale to approach one, two, maybe three potential lenders to back their portfolio companies. So it's a model where the lender is highly engaged with the owner and the management teams at a very early stage. And because of those direct relationships, you are negotiating the documents directly with the owners and with the management teams. And that generally leads to really good structured documents from a lending standpoint. And what the market typically focuses on is it also has an attractive risk adjusted return. We're generally 100 to 200 basis points incremental return to what you'd get if you were with a slightly larger or more publicly rated instrument.
It's very interesting. So interesting. Now, David, I'm going to take this next question in a little bit of a different direction. It combines the micro of private credit, some of the mechanics that you just referenced, with the current macroeconomic environment. So, David, you just told us private credit involves a floating rate loan paid by borrower to lender. Now, from a macroeconomic perspective in the US, it seems like we're on the cusp of an easing cycle. So, how does the potential impact of lower rates through the balance of 2025, how does that impact how you lend? And also if you could comment on how it could impact an investor's experience.
Yeah, so it's certainly a highly relevant question. But let me just back up a second and just as you say, explain the mechanics just for the avoidance of doubt. So when we lend to a borrower, it's always on a floating rate. So what that means is we lend at a base rate plus whatever spread and fees we decide makes sense for that particular company. Think about that as the credit premium over the risk-free rate. Now, clearly during rising or even falling rate environments, you'll have the base rate piece go up and down. That depends on the Fed or the central bank that provides the guidance on those rates. So, as you alluded to, it's a particularly interesting time now, right now, because people are generally assuming rates will ease. Obviously, there's a lot of controversy in the U.S. over the timing and the quantum of that relative to other geographies. That does mean if we're in an easing environment, our returns will go down, but also the rate that borrowers have to pay us will be reduced. So they'll have more cash flow to grow and to support capital investments. The really important thing for everyone to remember is This is all known to the market. Like we have a forward rate curve that goes out 2 to 3 years. So when we talk to our investors, we talk to them about what we expect the forward base rate to be over the next 2 to 3 years. And we expect it to come down into 3 to 4% range, maybe even a little bit lower. And borrowers can also plan because they can look out and they can either fix it or they can kind of, in a sense, hedge those, or they can kind of expect and have guidance as to what kind of cash interest they're going to have to pay. So if we come back now to the experience that investors have as a result of that, we have always said over a long period of time, unlevered private credit returns should be something like 6 to 8% after fees. Now, over the last couple of years, we've been 10 to 12%. So we've been way above that because we've been in a high base rate and a high spread environment. And so what we've said to investors is we need to account for the fact that rates will decline. So we're expecting unlevered returns to end up probably at the high end or slightly above that 8% mark that we said is the kind of top end of the long-term guidance. And if you're a levered fund, that would typically be more like 8 to 10%, or maybe a little over 10% on a levered return after expenses and fees for investors.
Now, David, for my next two questions, I'm going to zoom out, given I got into the weeds a little bit there. First question: is private credit now too big to ignore from a systemic risk perspective? $1.5 trillion, enormous size. I'm just curious, how should we think about this from a risk perspective with regards to the financing industry?
Yeah, it's funny. I was just forwarded an article that related to this, which was written by J.P. Morgan Asset Management, and it was about private credit, which is super ironic because for those of you that know, Jamie Dimon, who's the current CEO of J.P. Morgan, has been one of the most critical public figures on private credit and calling for regulation. Now, particularly ironic since they have a large balance sheet which has made allocations to the asset class. But what that report said, and I did think it reflected what we've been saying to investors for quite a long time, is that while the growth of private credit has been dramatic, call it 15% per year per decade, when you think about that relative to commercial or industrial bank loans, that's only grown at a call it 3%. So yeah, banks are kind of a little bit looking and saying, well, we're not growing at the same rate of private credit. So is that something that the regulator should be worried about? Now, when you pull back the lens and you say private credit is less than 10% of total corporate borrowing, it's hard for me to look at that and say it kind of rises to the level of systemic risk. Now, Jamie Dimon is a brilliant guy. He's been an incredible leader for JP Morgan. So I do think it's something that a lot of people are thinking about and focusing on. And so I do think it's something that gets a lot of public scrutiny. But importantly, as we look at our borrowers, we see good performance. Like, yeah, there's a tale of industries that are underperforming. Consumer's tough now, healthcare is tough now. But I think the most important thing about private credit is if you look back over the last 30 years and you think about credit in general, distress cycles are always driven by two or three industries. That's 50 to 70% of all defaults are driven by a small subsegment of industries. And so while private credit, you've got direct borrowers, you've got leverage provided by banks, it's not at the scale, in my view, to be systemic in terms of the risk. And it has the huge benefit of investors having huge diversification across a number of industries and different geographies in order to kind of mute any of that volatility you may see in certain segments of the economy.
Very good. Thank you for that, David. A related question: you mentioned earlier the relationship-driven nature of private credit and how many of these companies are too small to access the public markets. Northleaf has been around, a successful firm for decades. Suggests to me that deal sourcing for Northleaf is also a function of relationships. Maybe you could give us some insight into the nature of deal sourcing for a firm such as Northleaf in the private credit space.
When you think about corporate direct lending, the majority of that is driven by private equity funds. And obviously, what we do is we're lending to the borrowers that are part of their portfolios. And so the relationships you have with those private equity funds is really what drives the origination. There's capital markets people there, there's sometimes advisors, but ultimately that is the catalyst. So Northleaf is incredibly unique in the market in the sense that we have a private equity business that provides LP capital and also does secondary trading of LP investments for those same private equity funds. So we've been a relationship partner for those private equity firms for 20 or 30 years. And so we leverage a lot of those relationships, and we have built out the strategic partnerships for them to trust us as a partner and turn to us when it comes to the loans that back their portfolio companies. So I think for us, you're right, relationship is important. It's driven by private equity funds. And we have a very unique angle with over 100 mid market firms, given the multiple decades we've had in partnering with them on their own strategies. Now, clearly, we also have a global team. So this is people across 4 offices in Chicago, New York, Toronto, and London. That team is leveraging their own relationships. And so we really get the best of both worlds, a direct relationship driven approach by our global team, as well as our institutional relationship going back decades with over 100 mid market private equity firms across North America and Western Europe.
Thank you for that, David. I want to follow up on something that you shared with response to my prior question, just to get your insights at the industry level. You referenced some difficulties within healthcare and within consumer. Just curious, from what you're seeing, what could you share that might be of interest to our listeners?
Listen, it is an interesting time, and is a time where I think investors need to think about the type of institutional quality manager that they're partnering with and what their approach is to investing. Now, we have quite a wide lens when we think about the corporate direct lending. We're focused on North America and Europe, and we do a little bit of asset based lending. So, what we see today, asset based lending is probably the most attractive area. Europe is actually amongst the most attractive that we've seen over the course of the last 5 years. So we are tilting toward both asset based lending and Europe from kind of an asset type and geography standpoint. From an industry standpoint, we have said to investors we are worried about consumer. We have seen healthcare industry as a whole really have a challenging environment, particularly around managing the labor side of things, both the cost of that labor and the consistency of it, and a little bit across industrials. So we're tilting away from consumer healthcare and industrials, where we like in terms of industry exposure, and we've seen great growth and very stable performance. Financial services, tech, software, although clearly AI and some of the market volatility is something for us to watch. So those are kind of how we're tilting the portfolio. We've got a 7-person portfolio strategy analytics team that is constantly focusing on making sure that we're targeting areas where we find the best relative value, but also tilting away from geographies and industries where we see heightened levels of risk or concern.
Very good, David. Appreciate your insights there. Now, David, for my final question, I'm going to take a little bit of a different approach. You're clearly an expert on private credit. You spend your days focused on the space. On my end, I'm focused on portfolio construction. I wanted to share a recent case with you, and this case involves a high net worth Canadian whose advisor introduced a position in private credit, and they're actually working towards a 10% portfolio allocation. They're at 10% because the client doesn't need liquidity from that sleeve for at least the next 10 years, but the client certainly appreciates the contractual nature of the income. And they do also appreciate the level at which it pays above investment grade corporate debt. Overall, the portfolio is built such that liquidity can be accessed from other sleeves by the client and the advisor if needed. Now, that's just high level details, but I'm curious, what do you think about this particular use case for private credit by a high net worth individual?
It's a very common question. And to be honest, that could be the exact same question that we get from some of our institutional clients. I don't think it's a unique question, although I do think obviously individuals have some unique circumstances that their advisors will be well aware of. I think about it as having 3 layers. The first, and this is where I think having an advisor or having someone that can provide the education is super important, because that individual needs to understand what private credit is. They need to feel comfortable with the type of exposure it is as an investor. I think that's where we've spent a lot of time. I know McKinsey and others do a lot of time educating the market. And that's kind of the necessary layer that obviously they've already gotten from their advisor along the way. So when we talk to clients, there's 2 pieces of it. The first is obviously the allocation. So what is the quantum of allocation that makes sense? And you're right that we see institutional and individual investors think about kind of 2 to up to 20% as good allocations for private credit, depending on their facts and circumstances. So 10% would be right in the middle of that range of what we talk about with institutional and individual investors. And the second piece is the nice bit of private credit, like fixed income, is you can really chart out what the income is going to be over a long period of time. So if you've got an evergreen fund that's giving you a consistent exposure to the asset class, you're running at somewhere between 8 to 10% cash yield today. And you can really use that to project out. So while you may not have the immediate liquidity in way you would with a bond or a public equity instrument, you get that cash yield. And the final thing that's very important is the liquidity of the vehicle. So the asset class obviously can't be traded, but the vehicles that have been set up now, they do provide liquidity. It might be on a monthly or sometimes a quarterly basis, but that does allow the investor to accordion in or out. And they may decide that they want to start with 5 to 7 and accordion up to 10 over time. Or they may decide once they're at 10 to kind of lessen their exposure. And so you have that valve to manage the liquidity or the exposure to the asset class over time. So hopefully that's helpful. And like I said, I do think we're in a market today where individual and institutional investors are starting to think about private credit in the exact same way and see the benefits of the stability and the contractual cash yield as really enhancing the overall portfolio that they hold.
I said that was my final question, but that was such a great answer. I have just a short follow up on that. I'm
You
just
always have
curious because you
follow-ups,
have,
right? This is not my
I
first time
do.
with you. There's always going to be follow-ups.
It is true. It is true. You got me. But you've been in this space for quite some time, David. You've seen the growth, but you've also seen an evolution of the investors. How different is it, whether it's institutional or retail? How different is the level of sophistication or comfort with the space just over the last 10 years?
So, I mean, there's no doubt that it started with large institutions, right? It started with pension plans, insurance companies, sovereign funds. So, there's probably a benefit of experience over a longer period of time. I mean, this is an asset class that's been around for 40, 50 years. It started with banks, it transitioned in the early 2000s to mostly institutions. So, that's one component of it. I think the more important component is that it is intuitive to any type of investor. It's a loan to a company. And you can look at the company. And so, whether you're an institution or an individual, you can look at the portfolio and you can see, oh, yeah, it's a software company. It's selling software to thousands of corporate clients on a 5 to 7 year contractual basis with annual inflation escalators. They've got a very contained R&D and sales budget each year, and they generate an enormous amount of cash flow. You could go literally company by company, and it wouldn't be hard for any client or investor to understand why the loan makes sense. And then obviously the loan itself, while there's a 350-page document that we negotiate for each individual borrower, the key terms are pretty straightforward. They got to pay quarterly interest. It's on a floating rate basis. And we've got covenants. So if the business underperforms, we can get engaged and we can make sure that the business starts to either sell assets or alter or pivot their business to ensure that they can continue to provide for the lenders and for the recovery of the lenders in that situation. So yes, institutional investors have probably in general longer trajectory. What we've seen over the last 5 years is individual investors have seen it as a really important component of their portfolio. And we're seeing an acceleration, almost a catch up of those individuals to where institutions are in terms of, as I said, somewhere between 2 and maybe even up to 20% allocation. And then that would sit alongside what they might be doing in public markets or private equity or infrastructure, depending on how they think about their broader private markets allocation.
Excellent, David. Thank you so much. I could ask you a question for hours, but you do have a portfolio to run, so I'm going to have to save my keen interest and exuberance for our next conversation, and be sure to have you back on the podcast sometime soon. David Ross, thank you very much for joining us today.
Thanks again for having me.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.